All right. So, you want to come on up? For those of you who don't know, I'm Dave Kelly, and this is Josh Kattenberg. Josh, you want to tell them about yourself?
Sure. So, my name is Josh. I own Real Property Management with my brother Derek in the back of the room here. We've been doing it for about 9 years, manage about 900 units. Wrote the book in front of you several years ago, so that's yours to take. If you've got one, feel free to give it to a friend, whatever. I'm excited about what Dave's got to share with you. We kind of put this together, so this is our first time team teaching, so we'll see how this goes. But he's going to bring lots of concepts, and then I'm going to do the last hour breaking it down, doing actuals, and going through a real in-depth analysis of the property and see what we can learn from it. So that's what we're up to.
Sounds good. Yeah, some of these terms I think that we go through, you're not used to dealing with them all day long, but we really want to give you a feel for what it takes to help your clients buy property and invest in property, or maybe yourselves too, so you have a comfort level with the numbers, the lingo, so you can talk about it with whoever you want to talk about with it, and to help increase, your listings as well as your buyers and make them more successful. I'm a certified mortgage planner with Fairway Mortgage, the only certified mortgage planner in the state, and that allows me to teach classes like this for investments, and we've got other classes we can teach too. But for those of you that don't know, Fairway Mortgage, we're in all 50 states. We're the 4th largest lender in the country, and we keep growing every single year. So it's a great company to work for. But let's get into it. And as Josh mentioned, we're going to start really broad, okay? And again, I want to paint the picture that's not working. I want to paint the picture for what it's like for your clients and what are their concerns. Because I think sometimes when we get into working with people, we just, we forget what's going to make a difference, what's not. So we're going to look at what's it mean to buy a property in LLC. You've probably heard that. You've probably got clients that ask you questions about that. Buying a house in an IRA. And then we're going to go into kind of broad, as Josh mentioned, as far as cap rates and net operating income. Cash on cash, we're going to calculate that. Rate of return, we're going to calculate that. We're going to look at different financial options for real estate investors, and again, follow 7 keys of profitable real estate investment, because it's not just about buying the investment property, because anybody can do that, but it's got to be profitable for your clients too. And that's where hopefully you can, with these tools, you can help them with that. And then talk about some rent to own and sale leaseback strategies too. This is obviously a forum that if you have questions, feel free to ask anytime, okay? We've got all kinds of caffeine. I loaded up on the coffee back there. We've got Coke, Diet Coke, Dr. Pepper, Diet Dew in the cooler. So, and there's water back there too. And then donuts. Welcome. So I think that's everybody. It's awesome. So let's just talk real quick about the state of the housing market. People think that the housing market, the inventory is down. There's nothing out there for my clients to get into. But actually, if you look at Fannie Mae, and NAR actually came out, and they do a study every year as far as what are the percentage of investment properties that are purchased. And it averages between 15 and 20%. If you look this up online, like this is an example, the 2017 NAR Vacation Home and Buyer Strategy. It's a great resource. In the Midwest here, it's actually 21% last year. Purchases of properties purchased were investment properties. So that's 1 in 5. The clients you're looking at have a chance to buy an investment property, and we want to make sure we can help them to do that. And it breaks it down too, that the median price for investment property is $155. What was it? 29% people pay all cash, and the rest are financed. And the median square foot for an investment property purchase was 1,500 square feet. So this is online, and all these links, and I'm going to share a lot of links and a lot of websites that you can go to find things out. If we have your email address, we'll send that all out to you guys afterwards so that you have access to all this stuff, okay? So you can look it up. But great report. Good thing to go through on that. So as I'm an investor, if I'm buying a property, of course, there's probably 3 risk factors that go into buying something. I've got to worry about, is there inventory out there, supply? Demand for houses. What are demand? Are people going to want to rent my house that I buy, right? And is it affordable? We got to look at, is this affordable for clients in the marketplace to buy or rent the property? And I don't know if you saw that Argus Leader article that came out last summer or just this summer saying that it's a great time to rent. It's not a good time to buy. So love that article. Love the Argus Leader support for our industry. But I think this is a long-term thing, and some people maybe get into investment properties to do it for a short-term basis. Some get into to do it for a long-term basis. I think long-term, obviously, everybody has different goals on what they want to do. But let's look at housing supply. Where do we find info on housing supply? Well, where do you guys get info on housing supply? You belong to an association, right? Most of you. Sioux Falls MLS, Raise. So Raise publishes things. So what's our inventory right now? Dan, do you know?
Low.
It's low. So how many listings are on the market right now? 700. And how many are selling in a month? There's got to be more than 700 on the market right now for total listings out there.
Last time I looked, I thought it was like 800 and something. It actually
Was it?
getting pretty low.
Okay.
I haven't looked for a while.
And how many are we selling a month on average? Let's just use an easy number. Let's say we're selling 400 houses in the market a month, okay? So that means we have a 2-month supply, right? So that's pretty low. What's considered, and other places you can find this at, of course, the Census Bureau has things, NAR has things, but that's your job, is to inform your client, kind of let them know what they're up against when they're out there looking for properties. So basically, again, we just went through that example. What's considered a balanced market is their 6-month supply. Okay, that's a balance. So let's say, for example, we had 400 houses a month selling, and there was 2,400 listings. There used to be a day when that did exist. Then we would be balanced. So right now,
at the end of August, it said 3.4 months supply.
3.4 months. Okay, so there you go. So we're still definitely in a buyer's market, right? And you guys feel it out there. Nice thing about, you can go to this. It's Fred. Anybody heard of Fred before? It's from the St. Louis Federal Reserve. They've got so much information out there. It's just crazy. And again, different markets, and we are in the Sioux Falls market, right? But are there different markets that have more supply? So maybe sometimes you can apply these concepts if you're looking on your own to go to a different market too. But in July 2018, nationally there was 5.9 months. So balanced market then, basically. Okay.
Specific, do they have some of those reports specific to a Sioux Falls market?
They don't let you drill down to that. It's all national stuff.
All national.
Yeah, it's a good question. But what's interesting is, as I was looking at these charts and looking at the numbers, so the months of supply you can see here, and think about, people worry about the fact that there's not any inventory out there. But would you have liked to have bought a rental property back maybe 90s? What would that look like now if you had a property from the 90s, right? So my point is, yes, inventory is limited, but if you're going to get into investment properties, they're going to cash flow. That's the most important thing, okay? And that they're going to appreciate in value. Those are the reasons that you're getting into it. Don't let your clients get too bothered with the fact that there's not enough inventory out there, or let them feel that way, okay? You're going to work hard for them to find them the right property. So, housing demand. Homeownership rate for the United States, basically, you always see this number published. You see that everybody always puts it out there. So right now, end of February 20th, 2018, 63.9% of people owned a home in the United States, of households owned a home. And notice there's an uptick here coming up. So, of course, we had all of the easy loans in the early 2000s that anybody that could fog a mirror was able to get a loan for buying a house. That's when homeownership rate reached its peak. But now, of course, it's coming down and then bouncing back up. And I just want to show you that Fred link. So I've got it. There we go. So, because there is something I want to dive into, because it does show also, I didn't get a screenshot of this, but it shows the rental properties and the affordability index. And I want to touch on that real quick too. So here's that chart that we just looked at. Basically, again, the homeownership rate, the percentage of people that are doing it. And then there is renting and owning homes. Let's see, I want to do renting affordability. So let's say I want to find out what is renting affordability on a national basis. Rent of primary residence, vacancy rate. So if you want to look at vacancy rate, again, they've got that on a national basis. I mean, the amount of information that's out here is astounding. I guess they do break it down. I see some states in here. It looks like it is state, Dan. It does do things by state. Should we see if they've got South Dakota in here?
They do have stuff on Sioux Falls, so they have the housing price index.
Oh, they do?
Yeah.
You've seen that? Okay.
I don't know if they had the other report for Sioux Falls.
On Fred, they have that?
Yeah.
So
Just type in Sioux Falls and you'll get.
let's see what we get. Unemployment rate. We know that's low. So here's housing price index. Oh, well, that looks familiar. Obviously, it's going up. Looks like they don't have the affordability thing. So there is some things in there for Sioux Falls. Let's see, vacancy rate for Sioux Falls. Where is the one that I wanted to go to, Fred? Oh, here we go. Okay, that's on another one. I'm getting ahead of myself. Okay, so that's Fred. I want to show you the housing affordability map too. We're going to jump ahead on that. So they also have a map that's pretty current for housing affordability, right? So how many people can afford houses in their marketplace. So nationwide, 59% of households, or 64% on average across metros, can afford typical monthly payments in their monthly area. So in our market, we've got the blue. So this is 66% of people can afford payments on a medium price single family home in our marketplace, okay? Now the one thing that if you click on this renters tab, I thought was really interesting. If you look at that, and let's drill down. So we've got an orange area for rentals. So 33 to 49% can afford a rental property. So 64% of the market can afford a medium priced home, right? But then out of the what's left over, basically, let me scroll up here so you can see Sioux Falls. We're in this orange category here where only the portion of renters can afford a rental property payment, okay, 33 to 49. So that's kind of interesting. So my point is that renting, there's a lot of people out there that can't afford a house. I mean, they can't afford it.
It was fake news then.
What's that?
If you're saying it was fake.
Yes, it was. Hey, Neil.
Subsidized housing is taking care of the rest.
Yeah, exactly. Well, right, exactly. That's where you see some of that subsidized housing. But the point I want to make is I think the market is kind of tapped out for people buying houses potentially, but buying an investment property right now is a good time to buy an investment property because you've got people that need to rent. Okay, and if you look out there, there's hardly anything out there for houses to rent for somebody to
That
buy.
will also tell you is that you can charge more for rent than people have to pay for a house payment.
Probably true. Yeah, I mean,
Actually, 40% more expensive to rent than buy right now.
I don't own a single house that they couldn't buy themselves and pay cheaper monthly payments.
right. Especially with rates being down there, but rates are, of course, not helping us out, right, Becky? I'm going the wrong direction. I know that's our fault. So the Fed has the jolts as far as what's going on with that. So obviously, if people, non-farm payrolls, people have more jobs. That's a good thing, of course. It shows the number of job openings. But I like that Fred site because it has a lot of information on it. We talked about the housing affordability. But again, to Dan's point, rent increases continue to outstrip inflation. Okay, because those rents keep going up. Sioux Falls came down. I think apartments. I mean, Josh, I'd let you kind of talk on that too. You are in the management business of
Yeah,
properties.
so it feels like apartments have flattened off a little bit just because of where the vacancy has gone, right? We've done a ton of building, and I think vacancy in January was 11.5%, and July was like 9.2 or 5 or something like that. But that's just because there's so much inventory being built, and so apartment rents I feel are flattened. But once we catch up, and people have been pumping the brakes on development as well, so we'll catch up and then we'll push again. Single-family homes, though, I think you're good.
Yeah, absolutely.
Single family homes for renting?
For rent, yeah.
So we touched on the housing and price appreciation, and so we're going to start going through some examples. Would you all agree that we could use a number, say, if we want to be really conservative for housing appreciation, 3%, is that a safe number to use? If you were buying a $150,000 property to rent, you'd probably plan on that going up more than 3% the next year. Morning, right? So we're going to use 3%, okay? The other thing just to touch on real quick is the mortgage market. What's going on with mortgage rates out there? Because you obviously, and we're going to go into leverage and all that stuff too, but rates are going up, aren't they? So that's a concern if I'm somebody that has to buy a house and I've got to have a mortgage on that to be able to rent it out, because that's going to affect my profitability of the house, isn't it? The higher the rate is. So what's going on with that is the Fed's got their mortgage bond buying program. That's tapering off this year, okay? There's, of course, the growing federal debt. Our economic growth seems to be good. I don't know how many numbers I believe with that. I mean, it seems to be good. And then you've got political events across the country that are affecting things. So how do mortgages get their money, basically? Just because I'm a mortgage banker, where do we get our money from? It's all the same, really. And everybody that tells you it's different is, I mean, all mortgages are going to, what happened is the bond investors are buying bonds that are packaged by Fannie Mae, Freddie Mac, and Ginnie Mae. Mortgage companies involved, and then of course it goes to the borrower. So the borrower wants to get a loan. The mortgage company, I don't care if you're a bank, if you're a credit union, if you're a mortgage banking company, you're providing that loan to them if they qualify, and then those are packaged up by Fannie Mae, Freddie Mac, Ginnie Mae, and ultimately it's the bond investor that's buying those bonds, and it's the investment appetite for those bonds that drives what the mortgage rates are doing. So let's just use a real basic example. If somebody has a rate of 4.5% on their mortgage, the mortgage company is probably on revenue is getting 0.5% of that loan. Fannie Mae is probably getting 0.5%. And so those bonds are being sold and packaged out there at, say, 3.5%. Okay? That's how those, and obviously as the rates are getting worse, let me show you, like, for example, this is a chart, the Fannie Mae, and each one of these, this is like if you're a mortgage person, you're looking at these every day, and the green is where the mortgage market starts, and then where it ends. Red is where it gets worse, and as this chart goes down, rates are actually increasing, okay, the price of rates. So we track that on a daily chart. So here is a 10-day, I think let's go 1 month, okay? This month has been really interesting for mortgage rates. This is the Fannie Mae 4% coupon. And what's going on with that? Come on. So you can see what's happening. This is going down. And as it goes down, rates are getting worse, basically. Now, and even on a daily basis, this is what, I mean, there's fluctuations in the market that's going on. Everything with mortgage rates is market driven. So we've got that risk too as an investor. Any questions about how mortgage rates are determined and that risk that's involved with that? I do think that right now, if I had to take a guess, I would say early next year we're going to definitely be in the 5s. I mean, they're going there pretty quick. As you look at what's going on with the Fed tapering off their program, we've got the tariffs happening with Chinese goods, right? What are tariffs going to do to the investments as far as what happens with prices when we have tariffs involved with everything? They're going to go up, right? And what's the number one enemy of mortgage rates? Tell me, pick on you. Inflation. Yes, Becky, who works for me. So inflation, right? Inflation is what's the biggest, because if I've got a bond out there and inflation's going up, that makes my bond less desirable, and it makes my return on that bond less desirable too. So I don't like it when inflation's involved. So I've got to get a better return to counter that. So that's why with all the tariffs and with the tapering and with the debt and all of the financial things that are happening out there, we're going to have increasing rates. Okay, so that's the picture that you're going to have with your clients. So it's very good. I think it's very important that they have somebody that's helping them with that to kind of guide them through that process. Let me go from current slide. And as this just shows a chart, basically since 2008, who's been the number one buyer of mortgage bonds out there? It's been our federal government, okay? And they're tapering that off. So that's why as they taper off, less demand, and that's why the prices have to go up. So you can see here, I mean, this thing's just been stair-stepping down too. So there's a lot of forces that are going in to drive those interest rates up. I do think the fact that we have the low unemployment rate is good. I do think we're starting to see some people's salaries are going up. There's some pressure there to kind of improve that. So I think that's good. That actually gives people confidence to go out and buy houses. We've got to worry about that growing federal debt. I don't know how they're going to ever deal with that, because this is the first time that we've had like tax cuts, and we've got the debt growing and it still grows. So that's risk of inflation too, okay? So let's get into some numbers then. That was just a brief overview of the market. So when you're buying investment properties, there are two ways to make a profit, okay? Basically, the appreciation of the property, we talked about the 3% number, and then your income or your cash flow on a monthly basis, right? That's pretty basic. I want to talk about buying properties in an LLC, because this is the thing that I know a lot of people talk about. I get asked this question every time when somebody wants to buy a property, an investment property, okay? The thought is you buy an investment property in an LLC to protect yourself. Obviously, if an LLC is a separate company that you form, that basically you want to structure it so that the LLC is owning the property. So let's say tenant gets hurt, something goes wrong. Okay, my risk is limited because it's the LLC that's responsible for taking care of that. There is a problem though with that, because if you're using cash, no problem whatsoever. You can do that and structure an LLC, it's not a problem. However, if you're leveraging yourself to buy a property and then you want to close, does anybody find anybody that's doing loans and lets you close in an LLC on a residential loan? There isn't. There's only one lender in the whole United States that does that right now, but there really isn't in the Sioux Falls market. If you're buying a 1 to 4 family residence and not a commercial loan, you cannot structure that in an LLC, okay? The reason for that is the mortgage contract, and I want to show you that. So all South Dakota mortgages, if you read the fine print that you're signing, it's basically in 18, you're not going to transfer ownership of that property, okay? Just a little bit of a personal story on this. I used to be the president of Core Trust Mortgage, okay? And gosh, that was back, I guess, in the early 2000s. So Fannie Mae, we sold all of our loans to Fannie Mae, and Fannie Mae did an audit. And what they found on their audit is that 90 of our investment buyers had decided to switch their ownership from their own ownership to an LLC. And guess what they did? They sent us a letter, and they wanted us to send all of our clients a letter saying that their loans are going to be due in 30 days. Okay? 30 days. Yeah, so obviously we scrambled, we got in touch with all of our clients, we had them switch their ownership back from an LLC to their own names, and then Fannie Mae was okay. So I just want to make you aware that if you're structuring your purchase with the mortgage documents clearly state you can't transfer that ownership, okay? Can't do it after closing. Neil.
Why do they care?
Why do they care? Because you're transferring the ownership. So they're making the loan to you. It's just ownership, period, right? So they're not saying, there's nowhere in here where they say you can't do an LLC. They're just saying you can't transfer that ownership because the loan is made to you, and they're basing their loan decision and their credit qualifying on you. You could transfer that ownership to somebody else, not in an LLC, and then they don't know who that person is. And so that's why that's in there, is to limit. Does that make sense? Because they want to make the loan to the person that's actually on the loan
Why were
document.
they transferring it from their own name to an LLC? Good question.
Why were they doing it? Well, as an investment property. They didn't want the risk. So the thought is if you have it structured in an LLC, something
They bought
happens.
it and took title, they didn't think about risk.
Well, what they did is they closed in their name, and then a month or two later, what they did is they did a quick claim and they transferred it to the LLC. So they didn't close it in an LLC, but that's basically that's what the common thought is to do. Now, another way you can protect yourself out there is you can just get an umbrella policy, and that should afford some protections for something like that happening. I just wanted to make you aware of that. There's nothing that would stop you or your clients from doing that, but just a heads up, if that loan ever gets audited, I don't care if it's Fannie Mae, Freddie Mac, Ginnie Mae, or whoever is involved in the process, they could call your loan due within 30 days, okay? So.
Can you say what year that was that happened approximately?
It was sometime in the 2000s. You know, I can't believe it's 2018 someday, so I mean.
I just wanted to think of the recession and all all the hoopla that happened.
I think what happened is it was a result of all of the properties that, it might have probably was after 2008, I'm guessing, when there were some defaults. And they started, I'm guessing we weren't alone in that. I bet there was a lot of people that were getting audited with their investment property purchases. So, anyways, any other good questions?
Did I hear you say nowhere in the United States can you actually do a mortgage through an LLC?
Well, there's one company that does,
Residential property. Right.
but they're not market driven rates, of course. I've got the link for that.
And you can do a commercial loan.
Or a commercial loan. Some commercial lenders allow you to structure that in that too. Yeah. So
that's typically a higher interest rate too, though.
yes. Yep, and probably going to be a shorter term, not going to be a 30-year fixed rate mortgage. Yeah, exactly. So just a heads up on the LLC thing, okay? Okay, what about buying a property using an IRA? You've probably maybe heard about that. Want to buy an investment property. Now, there are rules around that. There is one lender, IRAlending.com, and they do allow you to do that. However, it's a non-recourse loan, and if you get any income from that property, that's taxable income. Okay. Likewise, if you go to sell it down the road, that's an appreciating asset. That can be taxable too. So just be careful with that. Not a cure-all, be-all, and of course, there's higher rates with that too, and there's fees. So if you're looking for it, IRAlending.com, they do have some things out there with that as far as buying a house or investment property with an IRA. So let's get into some numbers, guys. And again, the whole purpose of this is we're going to start really, really big, really, really broad. So some of us might be really frustrated with the pace. But I think it's good just because, again, it's going to get real detailed real quick, okay? So net operating income. That's the annual net cash flow of property after deducting the operating expenses, but before deducting the mortgage payments. Why do we care about net operating income without a mortgage? It's a way to measure the property, because some people buy with cash and some people buy with a mortgage. So what we care about with net operating income is our gross rental income less our expenses, okay? And that kind of gives us, again, the net operating income. After that, we take out the mortgage expenses, okay? So if I had a $48,000 gross rental income and I've got $12,000 in property taxes and insurance and expenses, then obviously my net operating income is, anybody? 36,000, thank you, Dan. Okay. Now, I've got 24,000 annual mortgage payments, and I've got 12, so after that now, so I've got my 36,000 less my 24,000 annual mortgage payments, my positive annual cash flow is 12,000. Has my net operating income changed? This is important because a lot of our formulas that we use are based on net operating income, okay? It does not change. Okay, because again, keep in mind the net operating income is just for your revenue minus your expenses. Okay. Okay. Anybody heard of cap rate before? Okay, so cap rate. Cap rate basically is your net operating income that we just went through divided by the property value. It's a function of the profitability of the property divided by the value. That's all it is. It's just a measure to compare other properties to. Okay, it's nothing scary. It's nothing that's, it's just a measure. Okay, because people think cap rate, what is that? I don't know what that is. Just remember, it shows the profitability of the property before we do any mortgage expenses. Okay, now we can also take the property value times the cap rate to get the NOI. We can play with these formulas to get different numbers to kind of compare things to. And if I know what the net operating income of the property is, and I know what the cap rate is in the marketplace, then I can come up with the property value. Okay? So solving for cap rate is again the NOI divided by the property value. What is my cap rate here? 10? Yep, 10% cap rate. Now, let's say I want to solve for net operating income. I've got a $500,000 property, and maybe I've got a 10% cap rate. What is my net operating income?
$50,000.
Very good. Now I know what the net operating income is, and I know the market cap rate. So what should I maybe charge for that property? Good. Anybody? I mean, again, there's some people in here that are probably more advanced. I know, I just want to make sure everybody's got this because this is the basic stuff and then we get harder. Okay? So let's go through it. Now, I've got in your packets, I just want to point out, so you can jot some notes down. I printed out these examples. Some of you have got it open here. And so that will help you. You can jot down some notes and then take that and write in the answers if you want, or scribble on or doodle on the side, whatever. So let's go through this example. I've got a $325 list price. Right now, the property is getting $2,000 a month in rental income, and I've got $650 a month in expenses. So what's my monthly net operating income? I should have kept my candy so I could throw it at you guys when you have questions. Net operating income. Remember, what's net operating income? It's my income less my expenses, right? Okay, so that'd be $1,350. That's my monthly net operating income. Now, do I care what monthly net operating income is? Probably not. Most things are done on an annual basis when you're comparing financial properties, okay? So this is not hard. My annual net operating income is $1,350 times 12, right? So we're at $16,200. What's my cap rate? Somebody got a calculator? Phone calculator? I know most of your names. I'm going to start calling on you. I know some of this is basic, but I think it's good to get a good foundation here, okay? Anybody? What is cap rate?
About 5%.
4.98, yep. Very good, thank you. Yep. Jeff, whoever else, Becky, okay. So, cap rate, we know this is what our cap rate is right now, but you know what? We know in that neighborhood, the going cap rate is 5.5%. And I'm gonna list this property, right? Or I'm gonna buy this property, so what do you think, what's the maximum price I should pay for this property? If the cap rate is higher than what the actual one is on the property, what should I pay for this? How would I determine that? Thank you, Dan. 5. Very close, yes. Some odd cents, that's all right. So that's basically, I shouldn't pay the list price for this property because I know what the cap rate is, and so again, that drives down what the value is for the property that I should pay for the property, okay? Any questions about that?
Now, hold on a second, Dave. Why, when the cap rate went up, did the list price go down?
Merlin, when the cap rate went up, well, the cap rate we know is, well, this is the existing one, right? What do you see about this that maybe $325,000 property and I'm only getting $2,000 a month in rent, right? So remember, so to answer your question, we've not changed anything over here, right? This is fixed because we have the financials on this property and there's probably a tenant in there renting it for $2,000 a month. And the expenses, keep in mind, we're not taking into account the mortgage payment right now, right? So if that all stays the same, this has to basically drive down the price for the property because we know that I better do what over here? Better get more rent, right? Okay? Or I better find a way to reduce the expenses, which probably isn't going to happen. Okay? Does that make sense?
Yeah.
Okay. So that's why that net operating income, or the cap rate, if you know some of that information and can work with some people that can help you share with some light with what that might be in a neighborhood, that's really going to help you to know what's a valuable property. Should I pay that for that? Or do I need to raise my rent to try to get that to my cap rate? That's another good point too. So I own a property, and what's happening as you own properties in Sioux Falls, they go up in value. If I haven't changed my rent or changed my expenses, my cap rate is probably going the wrong direction, right? So I got to make sure I'm adjusting that.
Are agents actually typically doing that, getting that specific of in this couple blocks, the cap rate has been 5.5%? I mean, are there that many comps of investment property?
Well, where would you find that information?
Probably
Do they have rental information on there by neighborhood? No. Do you guys track that at all? Josh, do you guys track that?
You're gonna try to find comps, right?
Yeah.
Say what's sold, and
Appraisers have that information. So if you're buddies with an appraiser, you could probably get that information.
what we've been using is, Vendor Commercial does February does that seminar every year.
Okay.
And they'll give you some examples of what has sold in small multifamily, large multifamily, and commercial.
Do they break it down by neighborhood?
Not necessarily by neighborhood, because you don't have that many sales of those type of properties.
Right, right,
It's all, you don't have that much diversity for neighborhoods.
right.
Really what you get, like, say you get over there by the colleges, and some of that older property might be a little bit different than you get out in the edges where you get the, the newer homes, but for the most part, like I say, it's pretty universal across the city. It's just.
Yeah.
And one thing too, on the cap rate is, when you say the 5.5%, you can't go out there and say, I'm getting 5.5%, so here's what it's worth. You also have to have the seller willing to say, okay, that does make sense. So the cap rate, when you're looking.
That's one way of looking at the property, right?
Yeah,
Yeah,
the
it's a
cap
good
rate
point.
kind of like say, that's just as much as, that's a personal preference on what you're gonna get, but like I said, it's not gonna vary that much from one neighborhood to the next.
Well, or you could buy a property that has a whole bunch of repairs needed, right? Maybe that landlord has maxed that sucker out.
Right.
And they've got a really good cap rate, but now you've got to throw a bunch of money into it. That's going to affect your profitability
I know
too.
when you look at it too, you look at, if you like say, fourplexes and stuff like that, you look at what the current leases are to see if they are maximizing rent
Mm-hmm.
and how much longer they are, because you can sit here and go like, well, that's a good cap rate, and all the leases are set to expire within a couple months, and you don't have anybody lined up that's gonna be willing to pay that.
That is true. These are all challenges to buying investment property. That's a good point. Okay, so we're going to go through another example just to kind of put it in our heads what's going on. So I've got a $295 list price, $1,600 monthly rental income, and I've got $475 a month in expenses. Real simple math. What's my monthly NOI?
125.
So my annual will be that times 12, right? So once again, how do you determine the cap rate? Repetition is the best way to learn things, by the way. Divided by the list price, 4.5. So once again, if I know that the cap rate's in the neighborhoods, or I find that information in the Sioux Falls market that says it should be 5%, then the maximum price I should pay for that property is, say, $270, okay? Based on cap rate alone. There's other market factors, as Dan alluded to, that can affect that too, okay? But if I'm buying that property, this is a good measure for me to know, is this something that I should buy and rent out? Can I raise the rents? Can I get this that I need? It's something to think about, okay? Because you can get all caught up in the property and fall in love with it and think this is going to be a great thing, but if the numbers haven't been there and you can't drive the rents, it could be a problem.
Now, Dave, I hear you saying a lot of examples with cap rates around 5%. I've got investors talking about how they don't buy anything below a 10 cap or an 8 cap. Is that reasonable?
It is depending on what the investor is looking for, because if it's a newer property, the newer property is going to have a higher appreciation and therefore a lower cap rate. So they're looking for probably an older property.
Well, what are you guys finding out there? You guys deal with that all the time. What do you say? Well, that's a good question. What's a good cap rate in Sioux Falls?
Depends on what somebody's looking for.
Yeah. So.
I don't know if that's why.
Would it be sustainable to buy a 5 cap if you're paying 5% on your loan?
Oh, that's such a good segue. That's such a good segue, because we actually go into that. Yes, that's a very good question. I'm going to save that one for a little bit later, okay? So if I want to know, so my monthly NOI, let's say, this is a good example. So my monthly NOI, we've gone through these math examples, my annual NOI. So I'm not going to go through that one again. Okay, well, we're going to drive this down. So this is what we're going to do. Okay. So let's take this example, and I want to go deeper on it. So cap rate, so this again, $250 appraised value, $1,100 month rental income, and I've got $375 month expenses. Current property's cap rate is $348. So we've got the monthly NOI and the annual NOI. what should be my market-based monthly rent? That's the question we're going to ask ourselves. Is what should we know? We know what the value is of the property. We know what they've been getting for rental income. We know what their expenses are, right? That's pretty easy for buying that property. So you know the annual NOI. We know the cap rate should be higher. We could use 4, we could use 5, we could use 8. What should I be charging for rent? So the first thing you do is take the property value times the cap rate to give you the annual NOI that you need, right? You had the NOI over here from what it is right now, but I know it should be better than that. So I take my value, okay, times what should be my market cap rate, and that gives me my annual NOI should be 10,000. Not 8,700. So now, how much monthly NOI do I need? Well, obviously I take the 10,000 on an annual basis, that with the 4% cap rate, divide that by 12. So I should have an 833 a month NOI. Now my expenses probably aren't going to change too much, right? Maybe they do, maybe they don't. And I mean, if your expenses are going to go up from there's some other things that you're going to do to the property or some things that you're going to be involved with on an expense basis. So you got to calculate that in. But my monthly NOI is 833. But going back to the original example, the property's average monthly expenses are $375, so I should be charging $1,208 in gross rent. So that's the math that you run through to determine what the rent should be. Now, that's based on the cap rate information that's been provided to you for what you should get for that neighborhood.
Are we going to go through this again?
You want to go through it again?
Yes.
Okay.
Please.
All right.
We're over this time.
Okay. I'm glad you said that. Thank you. Okay. I don't know. I mean, Dan's throwing out answers left and right here. I don't know. I got to give Dan a hard time. Troy told me I got to give you a hard time, Dan. Okay. Cap rate example number 3. So, I mean, we could take another example too, but let's just break this out a little bit. So let's say we have a 250 value. Let's say, do I want to change this that much? I'm going to go real slow through this one, and then we might break out into another one, because we've got other examples that we're going to dive into that are more deep. So I'm buying a house for $250,000. They've had a tenant in there for $1,100 a month is what they've been charging for rent, okay? They signed a lease, they've got it in there, they're in there. They're getting a pretty good deal. $375 month expenses, that's take into account no mortgage payment or anything like that, or no mortgage expenses. Okay, so you've got, what do you got? You got your taxes, you got, maybe you're paying for some utilities, I don't know, you've got other upkeep things, okay? But that's been averaging $375 a month. You're able to determine the cap rate from this information that's provided right here. That's pretty easy. You can always figure out your cap rate if you know what the value of the property is and you know what your NOI is, right? So that's why we came down here. We knew what the annual NOI was, and then we can back into what our cap rate is. Okay? But my buddy who's an appraiser, or my buddy who's a property manager, or my buddy that's a realtor, who's really knowledgeable in this market, is saying, well, the cap rate in that area or in Sioux Falls should be 4%. Okay? So what do I need to do? Because my month's $1,100 a month, and that obviously for a $250 house, that's feeling pretty light. Wouldn't you agree? But then how do you know what to charge? Well, a cap rate, if it's a market-driven thing, and if it's something that's averaging something in the marketplace, I basically need to take the value of my property times the new cap rate that I want to achieve. Okay? And that gives me what should be my net operating income on an annual basis. So then I take that divided by 12, because what are we trying to do? Rent is monthly, right? It's not annual. So that's the only reason why we're doing this 12 thing, is because rent is monthly, and that's what we're trying to figure out. So we divide what our net income should be, divided by 12, and that gets us a monthly number of $833 a month. But have my expenses changed? Probably not, right? So if I want to figure out what I need to achieve with my net operating plus, because I got to pay those expenses, so what should be my rent? And basically I add those two together to get to my rent. Does that Still gray?
Oh, I'm still on the last stuff.
Okay.
I mean, the one before that one.
This one?
No.
This one.
Okay.
Let's take another example, okay? Let's say we've got a,
Hey, I'll give you a real,
Dan, give me a real example.
I'm buying a house, I never go through the NOI, I kind of eyeball it, but I just.
You eyeball it, yeah?
That's
That's
the
okay.
number they come up at. So I'm buying a house for $197,000.
Okay, 197 value. Okay, what are the monthly expenses?
Well,
Do you know?
when I do them, I don't, all I ever pay is the taxes, they're in charge of everything else.
But there's some upkeep. It hasn't been a rental before.
Well, that's what you don't know, it hasn't been, and that's as much as anything too, that might be like, say, when you're buying the single-family homes, if you haven't had a rental before, you have no idea what you can get for rent. So
Right, and that's where I think as an agent, you want to help them maybe a little bit, right? I mean, you don't want to promise that they can get anything, obviously, but maybe it helps to run through some of these examples to show them, hey, okay, let's talk to you guys over here. What's an expense, monthly expense on a single-family house for $200,000? What would you say? $500 a month?
But we like to split it out, you get your management cost, your mortgage, your insurance, and your maintenance. So throw in 8% for maintenance, throw in 10% for management.
Now I got to get my calculator out.
But of course, you don't know what the rent is in order to do that. So just put a number at it.
$500.
Put 50%.
Let's just put, can we just do 500 because it's easy? Expenses? 600. Okay. What's the NOI in the marketplace? What's the cap rate?
For a single family, I would say
4? Really?
Single family is low. I mean,
Okay.
Compared to a multifamily, it'll be in the 6.5 to 7.5 range.
Okay. So we know the value, right? We know the cap rate. So I'm gonna try to help. So what we basically want to figure out what's the rent going to be on this example, okay? So I've got 197,000, monthly expenses are 600, and my cap rate is 4%. So what should I charge for rent? So I take my value times the cap rate. So that's 197 times the 4%. That gets me to 78.80. So what does that number mean? What does that mean? No, but what is that? NOI, thank you. So that's my net income on the property, not counting any mortgage or anything. That's my net income. Now to figure out my rent, I got to divide that by 12, right? So 78.80 divided by 12 is 657 roughly. Now what do I still have? I still got my expenses up here. So my rent should be $12.57. Does that help? Is that what you charge, Dan? $1,500. That's good. So if your expenses are the same, then you can figure out your cap rate and your net operating income. You can kind of back through and have kind of all kinds of, you can have an all-day fun day with those numbers. Does that help?
Yes.
Okay, good. Okay, good. Good.
So let's go back to, you buy a property, you fix it, the value increases.
Right.
And then that's your value, the increased value.
Well, if your value increases, you probably should be what with the rent? To
Yeah.
keep your cap rate the same,
Yeah.
increasing it, right?
Okay.
Yep. Okay. Okay. Okay, I want to review, and then we'll do a break after this, okay? Because we need to get more caffeine, right? So this was an example of a client that I worked with. He was buying a 344-plex. He was a vet. He was buying the property to live in one unit and then rent out the other 3, okay? And so I just want to go through the forms again. I've got this example in your packets. Show me an example. There it is. It's this guy. Does everybody have this, by the way?
Yes.
Okay. Anybody not? Okay. So we're going to go through this. These are real live numbers. It's kind of funny. I was doing a seminar like this at a seminar last fall for just for commercial people that were in investment properties. So we're going through it. And after I went through it, the guy came up break and said, yeah, that was my property that you were going through. So I know he's not here today. So let's go through that, okay? I need an example of one, Jeff. I'm going to have to steal yours. So what I've got, basically the profit and loss from 16, so the September through December 16, and then January through August through 17. So that gives me what? 1 year, right, of all revenue and expenses. Okay? So what we want to do on the back sheet is, I could have sworn I gave myself one of these. That's what happens when you work late at night and you don't pay attention. Anyways, we're going to want to figure out the net operating income. And we're going to want to figure out the NOI and the cap rate, okay? So, can somebody give me a number on the annual income? I'm going to erase this and start over here. What's the annual income? I'm adding my rent income and laundry income together, right? And since I've got a fall and I've got it broken up, I got to add all those numbers together.
37,
It would help if I had one that worked. 37 what?
107.
107, thank you. So this is my income. Okay. What are my expenses? Can I just lump all those expenses together and use those expenses?
No, you take out interest.
And what else?
Depreciation?
Yes. Okay, remember, our expenses aren't taking into account the mortgage. We're just trying to figure out the NOI and the cap rate. We're not, because we can't base it on the mortgage. You have to determine, is it worth it for me to put a mortgage on this property? Because then I got to back those numbers out separately. But separate of the mortgage, what's it worth to buy this property? Okay, because if you're a listing agent, right, and you're trying to help figure out some of these numbers, and you're going to list it, you don't know if you're going to have a cash buyer. You don't know if you're going to have somebody with a mortgage. So that's not up to you to determine. You're trying to help determine what the cap rate is, okay, and what the net operating income is. So that's kind of the perspective. So we can't take out we have to pull out depreciation, because is that a real expense? Let's be honest. I mean, you have to do it if you have an investment property, but it's just basically an accounting thing, okay? It's not a real expense. And then the other thing is the interest expense, because we don't know if there's going to be a mortgage on that property or not, and we're trying to keep that out of it right now. Because you could have a great cash buyer that thinks this is an awesome property, and all they're interested in is the NOI and the cap rate, okay?
What's the amortization expense paid?
Amortization expense?
This is a real example?
Yeah, it's a real example. That's a good question, Dan. I don't know.
That comes out, right?
Sounds like a mortgage expense. It's a small one, but
It's a small one. I think I brought that up at the thing, and then I was wondering what that was, and that's when the guy said, yeah, that was mine, and yeah, I think that was his account. I don't know. It's a small number. I'd probably back it out. So what's our total expenses? So if you basically took all the expenses, less the depreciation, less the interest expense, less the amortization, what do you got, Becky?
I have 17,340.
I have 19.
We've got three different numbers. And I left my answer key at my other desk.
Times 3.
Oh, I had that
So
before I took
19.
out the depreciation.
Times 3?
Yeah, because for the annual,
Yep.
are you talking about annual expenses?
These are annual expenses.
No, this says September through December on the top.
Well, remember, but then the second page is January through,
Taxes, right?
those 2 pages equal 1 year.
Okay. I see.
I mean, that was all that was provided, so that's all they had. So we got to go with what we have. So you basically got to add those together. And notice there's no depreciation expense on the second page either. Yeah, I thought that was interesting too. So they're doing that on an annual basis, I guess. Yeah, it is. So we have to add all those numbers together. Anybody feel really good about their number?
On both pages?
Neil?
Yeah, 17,339.85.
17 what?
17,339.85.
Okay. Everybody agree with that? Close enough? Okay. All right.
All right, we're going with the number.
So the house was on the market at 340. So what's my net operating income, right? I take my income less my expenses. I can do that. 37,107 minus the 17,339. That gets me 19,768. So I divide that by the property value, 340. And that gives me my NOI of what? Okay, thank you, Dan. So 5.8% is my NOI. What's our cap rate?
That would be cap rate.
Oh, that was cap, okay. What's my NOI then?
Well, the 19, I want to figure percentage.
Okay, and then the cap, thank you, okay, yeah, and then the cap rate's a 5.8. So what should I charge for rent on this guy? It's a fourplex, right? Is this the right rent? Does it feel like it? Plus I got to divide it out by 4. And then again, so what you would do and what he did is he took the leases. He had 4 leases. Unfortunately, somebody was vacating, so he was going to move in owner occupied, 100% financing. And basically it worked out really well for him, I'll tell you that. Because basically the other 3 tenants were paying the property and the expenses, and he was living there for free, okay? Any questions about that example and how that can help, right? Because it helps to know what the cap rate is, determine that. It's a measure to compare. So you get 5.8. We've told ourselves that 4 is basically a single family one. You know, this is a little bit better because it's a fourplex, right? So it just helps us to determine what are the rents, determines what value I should pay for a property, what's the cap rate as a measure of comparison, okay? Any questions about what we've covered? Because I just want you guys to have that fixed in your head, okay? All right. Did I say break time? Ah, darn it.
Yeah.
All right, I'll give you a break. I didn't have it scheduled, but we'll have a quick break.
Okay, we'll get started. So the last section of this class, we want to look at, we're going to do a long form calculation of a rental property. I'm not going to put you through the pain of actually having to do it yourself. I'm going to walk through, I'm going to give you all the answers. That's what this sheet is, and it's double-sided, so one side you can take home, one side will fill out. I know there's cool tools out there that calculate all this stuff for you without you having to think or work or do anything. The challenge with that is numbers are slippery things. You get one wrong and the outputs are wrong. And then you start making bad assumptions based on bad data in, bad data in, junk out. And so going through the mental exercise of actually understanding how we calculate this stuff, I think is helpful. And then you can graduate to a tool, and when there's something that's not right, something will ping you, and you say, I wonder that something's not there. It must be an input. There must be something off. Let me go back because this doesn't make sense. So how we're going to do that is we're going to look at. I gave you the prospectus for River Run Apartments, and this is I've done this piece probably 4 or 5 times already. Started in 2016. This is a listing that Jeff Brooks has, so he's gotten a decent amount of free advertising from us. But he's actually got it under contract now. And so it's kind of interesting. Back in 2016 when we started this, it's gone almost for 2 years on the market, and now he's got a buyer. I don't know what he bought it for, but let's look at that, and we'll kind of compare 16 to 17 and then maybe even to today. Big disclaimer here, this seminar is not a substitute for legal tax advice, right? Seek your own attorney, your own accountant. We are going to talk some accounting stuff and some tax stuff. So, all right, Each section of this, I have taken the pertinent parts out of the prospectus, which you'll see kind of in this orange, and then this is going to be the section of the worksheet. And I would encourage you to fill out the worksheet as we go, because that way you'll take that home and you say, okay, I get how we came to the conclusions that we did. So River Run Apartments is essentially 48 units. I think there's like 24 garages. It's got appliances are included. There's some utilities included. The tenant pays for electric, phone, cable, and internet, but the landlord pays for the rest. It also has some decent upgrades, so roof, appliances, landscaping, those type of things. Now, as realtors, when you're listing a property for your clients, of course, your job is to put it in the best light possible. But you also want to sell it, because that's how you get paid, and that's what your client wants too. So it's interesting, as a realtor, you have one perspective, but as someone helping, obviously, the buyer's agent, you're trying to get them a good deal, right? You don't have to steal it, but you also want to make sure that you're getting them in a good property that's going to make them money over the long term. And so we kind of almost have to switch our hats back and forth depending on which side of the fence we're on here. All right, so let's look through this. So in 2016, they had put the price as $3.2 million. So on your page, right down here, let's put the purchase cost of $3.2 million. Go ahead and write that in. And I'm going to keep going, and hopefully you guys can see this. Maybe the back row might have a little trouble, but I'll point them out as we go. We're going to use their same financing terms. Now remember, this is 2016, so they got a 20-year amortization with 4.5%. Probably maybe couldn't get that today, but that's what it was in 16. And they've got nicely calculated out our debt service for us, both the annual and the monthly. Okay, so we got 20% down in this box here. And then if you do the math, I'm not going to make you do the math, but 3.2 million times 20% gives you $640,000 is your down payment or the cash invested. So that leaves us with about 2.5 million that we're going to finance at a rate of 4.5% over 20 years, gives us a monthly payment of $16,195. Annual payment. Sorry. No, it's monthly payment. Monthly payment. Okay, the next section on this sheet is depreciation. Did everybody get that? No. Okay, I'll give you a half second here. 20% down, 3.2 as the purchase, 640,000 is the down payment, 16,195 is the principal and interest. So normally when I'm calculating a property, I am not looking at depreciation. However, it is interesting, so I'm going to calculate it, and because it comes through on the sheet as the next section, let's do it. But normally I am not looking at it. It's going to be there, but in a realtor-filled room, this is incredibly important. So let's walk through it, and I'll tell you what a difference it can make for you and for your clients. There's several different ways to calculate depreciation. One is the straight line method. In that method, you're basically taking two categories, land and building. And that's traditionally what people think of. They look at the Minnehaha County tax records, and that's split in what the assessed value is for the land and the building. And I went to the tax records, and for this building, you've got $216,000 for land. Don't need to write anything down yet. And the building is assessed at $1.7 million, giving you a total of $1.9 million. Now what I'm doing to calculate for my purposes, because of course the building is $3.2 million, right? So we have to upgrade. Essentially what I'm after is the ratios. So to figure out what's the value of the land, how much percent of the value of the property is the land, just take the land value divided by the total value and you get 11%, which then you're going to get 89% as the value of the building as what's left. All right. However, if you look on my sheet and up here, you see I've got four categories. We've got land, personal property, building, and land improvements. Well, what's interesting is there's a system called MACRS, which means Modified Accelerated Cost Recovery System. Again, we could go deep into the weeds on this, but I'm going to try to keep this high level. What's cool here is that if you split this out into multiple categories, you can depreciate your asset quicker, which means you get more tax write-offs up front, which gives you more cash up front, which allows you to invest more money because you've got access to it. Basically, the government's allowing you to use the government's money, I guess your money that they're going to take from you, but they're going to allow you to use that up front because you can accelerate your tax write-offs. So let's look at what that does for us. And my columns got messed up here a little bit, but that's all right.
I'll show you how to calculate this in a minute, but essentially we've got our purchase price, land, personal property, building, land improvements. Personal property, this is going to be things in a rental property such as carpet or appliances is generally what qualifies as personal property. Land improvements are going to be anything that doesn't need the building to do its job, so sidewalk, driveway, irrigation, lawn, fence, landscaping, those type of things. So I'll show you how we calculate that. And we can do this like really quick, and then we can also go really in the weeds. Large property, so when you get multi-million-dollar properties, they actually commission a study, a cost recovery study it's called, and they will take an accountant and will go in and will basically document every piece of that building to see how they can spread it out or split it out, put it into different buckets, which allows them to maximize their depreciation. They will pay a good chunk of money to the accountant just to do that because the tax write-offs are there. All right, so on this property, quite simply, I said, hey, how much is carpet? Well, I looked at the square footage, 58,000 square feet. I said about 2/3 is carpet. So that gives us about 36,000 square feet of carpet times $2 a square foot. Gives us about $72,000 worth of carpet. Okay, just really rough estimate. Appliances. I know there's 48 units. I know there's 3 appliances in each. Times $500 per appliance, another $7,200. Okay, simple. So that gives us about $144,000 in personal property in that bucket. Land improvements, I got lazy because I didn't feel like adding up all the sidewalk and everything else. And I said, hey, let's throw 10% of that. Okay? If we want to we can get into the weeds and really calculate what the value of that is. Take a little bit more time, but for our purposes, we're going to use 10%. So if we have a $3.2 million property, 10% of that is how much? $320,000. There you go. Okay, so on your paper, what you're going to do here is 3.2 million times 11% of the value. Actually, let me jump back. Let me go back to here. So how I get to this point is we have the purchase price of 3.2, and we know that 11% of the value of the property is land. Can land depreciate? Does it wear out? It doesn't, right? So you can't take any tax depreciation on that. So we take 3.2 million times 11%. The value of the land is $352,000. Now we know the rest of it is building, but we're going to take that building category and we're spread into 3 buckets because we get more tax depreciation that way. And we just figured out on this other slide, we figured out what our personal property value was, and we figured out what our land improvements were. We guessed at that. And so we can do the math on it, and we know it's about 10% or 4.5% of the value of the property. All right, so here we go. You can fill this stuff in. Land value is 11% of the value of the property, or $352,000. Personal property value, 4.5%, or $144,000. The building value, 74%, or $2.3 million. And the land improvement value, 10%, or $320,000. This is where it gets fun. Because we've split this out into different categories, we can take more depreciation. So personal property in the first year, you can take 20% of that. If it was all stuck in the building, you can only take about 3.5% of it. But suddenly you can take all this extra depreciation. And since the tax law changed in this 2018, the tax cut, you'll have to definitely look into this or ask your accountant. But what I was just reading in the last couple of days, stuff that you bought this year, acquired this year, you can almost take like 100% of some of these categories. So there is some changes, but it's all pretty much in favor of the landlord, which is pretty cool. Now, once we know how much of that amount we can take, 144,000 times 20%, we can take $28,000 in write-offs, paper write-offs. We're going to tell the IRS, hey, Mr. IRS, even though I made money on this property, I actually had more expenses than I really had, right? These are paper expenses. We do the math, we end up with $127,000 in depreciation. Why does that matter? Quickly before we go on. What really rocked my world on this is, especially for realtors, real estate professionals, if you're a real estate professional and there are rules of what that is. So you really have to be engaged in real estate, property management, land, development, those type of things, and you have to be doing it over 1,000 hours, I believe, and for more than half the time. If you qualify for that, you get to use this type of write-off against your personal income. So if you're making a ton of money selling real estate, right, you're just killing it in the real estate world, and you're paying a bunch of income tax, if you would buy rental property, you could use a whole bunch of that write-offs to offset all that extra personal income that you have. Unfortunately, if you're not a realtor and you're not working as a realtor or a property manager, you can't do that. You'll be able to bank it, you'll be able to use it down the road, but you can't use it all up front. So to give you an example of how this works, I think it was about 3 years ago, I bought a duplex and we did our taxes, and the accountant calls me up and says, hey, bad news, you have to pay about $8,000 in income tax. You underpaid. All right, well, that stinks, but it doesn't matter that I'm a real estate professional. Well, yeah, it does. She does some calculations, and now you're getting a $3,500 refund, right? So about $11,000 split difference just by clicking the real estate professional button. And suddenly, that's $11,000 in cash difference in my family's checkbook. Now, full disclosure, you got to be careful on the backside when you sell the property, right? Because then the IRS is going to come calling for the tax that you didn't pay up front. And there's some ways to avoid that as well. Die, right? Pass it off to your kids. But there's a way to actually reset that value and never have to pay the tax. Yeah, you're all awake. It's good. All right. That was really quick, a lot of stuff on depreciation, but I find it fascinating, especially talking to this room, because it's phenomenal for what you can do as a realtor. Okay, so let's walk through what this property looks like. So here they give us the 2016 actuals, which is interesting. I'm always interested in that, but I have to remember whose side Mr. Brooks is on, right? He's on the seller side. If I'm on the buyer side, I'm like, okay, buyer beware, right? What's he telling me? So actuals and then the pro forma. So he's saying, hey, you know, you've got this kind of income, but this is what we believe that you could have. Maybe he's right, maybe he's not, but let's check his math. Scheduled gross income. So when you see this, what this means is this is paper income. You could have 100% vacant property and still show this $442,000. This is what I think you could get based on what I think the market is, etc. So he's saying we could get $442,000. Other income, we'll break that down in a minute, about $18,000. So total scheduled income, $461,000. Now vacancy. This is where it gets interesting. Vacancy, he's got 2016 actual versus pro forma at 5%. So in 2016, they had $70,000 in vacancy. Versus the pro forma, what he projects, when you buy it, you'll only experience $23,000 in vacancy. Our alarm bell's going off. Right? What's going on here? What are they pulling over on us, or is our opportunity here? And what are we paying for that opportunity? When you figure this out, this is about 15% vacancy. My question as a buyer, why? What's going on? Why? There could be all kind of good reasons for that vacancy. One of those that I'm suspecting is because of the improvements they've put in. So maybe they did some rehab. Maybe they've had some people go vacant, or some units go vacant while they rehabbed it. Could be perfectly legit, but let's be careful. And then, of course, we get the gross operating. So their gross operating was $390, and he's saying we're going to get $438. So we have to come up with a number at the end of the day on income. So let's break down. This is kind of the detail of what's included in that income and in that other income category. So let's look at other income. We already saw the gross rent income, but let's look at that other stuff. Convenience fees, okay, negligible, doesn't really matter. Tenant late fees, we'll come back to that. Let's look at tenant charges and damage cleaning along with forfeited security deposits. So let's think about that for a minute. We're talking about $4,300 in forfeited security deposits, and we're saying, hey, that's normal income. And my question as a property manager, I'm like, okay, I never see that on my bank statement, on my income statements. What I think this probably is, generally, when you forfeit a security deposit, you're going to apply it to a charge, right? Either an unpaid rent charge or a damage or a cleaning charge. Generally, it's not going to be just a forfeited security deposit. It's going to be for something. So my guess is that that should have been applied probably to damages and cleaning. Okay, that would make sense, and I'm good at that. Now, of course, is this income? Well, sure, but it's also an expense on the other side. So it's a wash, and that's probably more expense than income. So let's be aware of that. Tenant application fees. What this tells me is this is probably not a professionally managed property. He probably has a on-site manager that he's paying payroll to, because otherwise that would just kind of be a wash with the management company. Bad debt recovery. That's also another interesting one that he puts $41,000 in for actuals, which is fine, but then the pro forma at $41,000. Well, bad debt recovery. When we're buying the building, I'm not going to buy his payables, right? That's going to stay with the owner. I'm not going to try to collect on his lost rent. He can do that. So to call this an income, a normal income, is like, well, no, we're not going to call that income. Garage space at 3,500. Do the math for me. 28 garages times $40 a month on garages. How much?
Nobody's doing it.
Nobody's doing it? Okay. Say 12 to 15,000. Even if you said 40 times 3,000, or sorry, let's say 30 garages times $40. This is low.
Yeah.
Here's some opportunity, right? And they're not making us pay for the opportunity. Well, that's cool, right? So those are the things I'm looking for. Which ones are non-legitimate expenses or incomes, and which ones maybe are under-rented or underperforming? Because that's opportunity. And as a buyer, that's what I'm looking for. Legal fees, looks like that was an eviction. Yeah, you bet.
He said that's an opportunity, so what he has in for the actuals, are you assuming that he's charging too low for the garages? You think he can charge more?
They're either too low, they're not being rented. You'll see that. Oftentimes, if it's not managed well, they won't know that there's garages that are vacant.
For the $40 a month.
Yeah, that's reasonable. I mean, you might even be able to get more. Greystone, we're getting 70, right? 60 to 70 is not unheard of. What are rental garages? Like if you actually get a storage unit.
Yeah, I just wondering how you identify that.
Yeah, so I mean 40, I think I'm being pretty conservative, times 28, times 12, that's $13,000 full occupancy. And maybe you can get more on that. So, good question. All right, so that's what I'm looking for. I'm looking for opportunity, I'm looking for BS. All right, so let's look at, let's see, did I skip anything? Okay, so what I'm gonna do is, I'm going to take what I think should be the rents, so $442,000, and then what I added in was the garage rent. I just gave it to him, as he said, and I came up with $445,905. I'm saying that's gross rents in my world, and then I'm going to throw in an 8% vacancy rate. That vacancy rate, this is an art and a science. We could take the vacancy rate in the city, right? We've talked about 11.5% in January. We've talked about 9.2 in July. It's been trending up. What's it going to do in the future? I don't know. But it's higher than it has been, right? It's as high in January as the highest it's been since the recession, is where we're at. Now you could say, well, you know, single family is different than multifamily. That's true. But you got to think that vacancy rate, while one asset class is different than another, it's going to affect each other, right? So if I can go buy an apartment, a 2-bedroom apartment for $800 or $900, is that going to potentially push down the value of a 2-bedroom home, right? It could. So why 8%? Because it's a 1 month's rent. That's one easy way to do it. You can get, the thing with numbers is, this is why numbers are so slippery, because you can make these numbers say anything you want, depending on how conservative or liberal you want to be. So if I want to get crazy conservative, I stick not a liberal, like not conservative, unconservative, I would do 4 to 5%. And you'll often hear investors will do that. And this is why Brooks, when he put this in, he put it at 5%. He's putting it at 5% and the city's at 11.5. Well, it's like, okay, maybe you can get 5%, good for you, but maybe you can't. Then what do your numbers do? So if you put this number too high, you'll never buy a property, right? Because if you're so conservative, you never get in. And so that's that delicate balance of trying to get it right. Yeah. So anyway, we take our gross rent revenue, let's take out our vacancy, our gross operating income then is $410,000. All right, so let's break down his expenses. Actual real estate tax, $40,000. I looked them up on the website, $38,000 is correct. So that is, for whatever reason, they went down. Property insurance, this is interesting. They paid $16,000 in 2016, but now they're saying, hey, it's gonna go down to $10,000? Okay, well, that's cool. But why did he pay $16 then? I don't know. Maybe we just need to go get our own bid. Go find out, because that's definitely an opportunity. Administrative expenses, we don't know what's in there, but he's saying $19,000. We'll talk about that in a minute. Utilities, that's a big number, $62,000. That could be some opportunity, right? Is there inefficiencies? Could we upgrade some stuff? Could we put it on RUBS, ratio utility billing system, and pass some of that expense off to the tenant? Operating and maintenance, I think this is quite low. My guess is there's some mixture going on with those unnamed administrative expenses. Again, this becomes you have to, at this point, you go to the property and say, okay, is this an A, B, C class property? Has it been kept up? What kind of deferred maintenance are we looking at? And think about how much do we want to put in when we calculate our pro forma for expenses. So while it's interesting what he's got, quite frankly, I don't care, because I'm going to use my own number based upon the condition of the property. Grounds expenses, that's interesting, but again, that's lawn and snow. You probably should get a price on that. Payroll expenses, here you see the on-site, could be a manager, could also be on-site maintenance. So some of the maintenance costs could actually be hidden here. So why this is so low, it could be that there's actually payroll happening for an on-site maintenance person. And then miscellaneous taxes, licenses, permits, etc. So here's what, on your paper, what it looks like. Real estate taxes, $38,885. Repairs. So my number, what I'm doing here, there's a couple different ways you can calculate this. Traditionally, how people think about it is as a percent of rent, because that's what makes the most sense in the sense of your P&L. You're like, hey, yeah, maintenance was 8% of my gross rents. But when you stop to think about for a half a second, you understand that intuitively that doesn't make sense, because do expenses care what the rents are? Does your furnace think about, I'm going to quit now because I know he's got this kind of rent? Doesn't matter. What really matters is what's the value of the property. So the larger the property, the more square footage you have, the higher the expenses are going to be, right? The bigger the furnace is going to cost to replace it, to repair it. And so I think it's a better calculation to look at repairs as a percent of the value of the property. So you might think about it as 1% of the value of the property. So if the property is worth $100,000, you're going to spend $1,000 in repairs per year. At least that's what you should budget. If it's an older property and worse repair, that number's got to go up. Or if it's a brand new property, that number can come down. However, being a person of habit, I believe what I did, I put 8% of rents. So $32,800 is what I've got as an estimated amount. Utilities, I use this, sorry, let me go down. Management, I think I calculated that. This is management fees, so this would replace the payroll, and I do that as a percentage. I can't remember, I think I put 8% here. Insurance, I took his lower number, assuming that he knows something we don't, assuming that he's going to get a discount. Utilities, I took the full price, but also thinking that there might be some advantage to me, perhaps finding some efficiencies. Leasing, I'm figuring that on average in an apartment complex, properties are going to turn, how do I want to say this? All the properties are going to turn every other year. So the average lease length is about 18 months. So if you take a property that's got 300 units, 150 of those are going to turn each year. The other 150 will renew. Now in single family, you're like, well, how do you do that? You have to average it. So the average then is about 18 months. And if you're getting higher than average, good for you, but you have to ask yourself, if I'm keeping a tenant for 10 years, why are they staying so long?
Yeah.
It's great, but I'm probably under rented, right? I probably haven't moved the rents up like I should have. Now maybe I'm okay with that, because then it kind of avoids some leasing expenses, some advertising expenses. I don't have to deal with turnover, but there's always a cost benefit to how long a tenant stays. But that's the national average, is about half turnover every year. And so you're going to have leasing or advertising expenses. And then other expenses, I think that's where I've got the lawn and snow. Add it all up, you end up with $205,000 in expenses for the year. All right, so we're getting down to the bottom of the page. So here's where we look at our benefits. So let's start. Gross operating income is the total amount that's on paper minus what we think we're going to have for vacancy, so $410,000. Take our operating expenses of $205,000. We subtract the income from the expenses, and what does that become? What do we call that thing? Operating income minus operating expenses. NOI, thank you. Net operating income, good. That's $204,000. Then we also have to pay for our debt service, principal and interest, to figure out the cash flow, right? So we're going to take that out now, $194,000, leaves us with $10,000 at the end of the year. That's the money that's going to go into our checkbook. That's the money we can pay for gas and groceries and whatever else. Well, wouldn't you like to know that before you buy it, right? Or what are the opportunities? What can we do to make it worth it? What can we do? Let's say this. Let me reframe it. It's not worth it for $3.2 million. But what is it worth it for? Right? Because we can make offers. So let's think about, now we want to go down and look at what our next benefit is. So we got cash flow as our first benefit. We mortgage the property, so we have principal reduction as the second benefit. We're going to take our total debt service, subtract out what we paid in interest, so $194,000 minus $113,000 means that we have principal reduction of $80,000. So what this represents is the money that is increasing in equity, right? We don't see it in our checkbook, we can't spend it, but we are going to pay taxes on it. The IRS is going to charge us for that. And hopefully when we sell the property, that's where some of that return is coming from. All right, now our depreciation. So now we'll take that stuff that we worked on at the beginning of the calculation and look at how it affects us. So we start with our NOI, $204,000. Then we can deduct our interest still, right? That I think has not changed in the new tax law. Rental property, you can still deduct the interest. On your personal home, it gets a little bit iffy, depending on your situation. Total depreciation, we figured all that out. So we're going to deduct another $127,000 in expenses, even though we didn't have those expenses. Leaves us with a taxable income of $36,000 negative. So how much did we put in our pocket at the end of the year? We put $10,000 in our checking account, and then we go and do our tax return and say, Mr. IRS, I actually lost $36,000 on this property. How do you like them apples? I like that stuff. Now, let's just assume I'm moderately successful and I'm making about enough money to be in a 28% tax bracket, and I'm a realtor. What does that mean for me? Take your $36,000 negative times 28%. That means you're going to save $10,000 on your taxes this year that you would pay to the IRS if you didn't have this property. If you're not a realtor, what this would mean is that negative times 28%, it would just end up being zero. You just would not pay any taxes. So even though you put $10,000 in your pocket, you just would pay no taxes on it. And then the excess depreciation would just carry on year by year until it actually wears out, and then you would start paying some taxes on the income. All right, then appreciation. I went really conservative here and said 2% appreciation, right? Rental properties, you're not going to look at when you're looking at multifamily, it's not going to be about the housing price index, right? Housing price index, 3 to 6% in Sioux Falls. A rental property is not going to care about that. What it's going to care about is the NOI and the cap rate. How quickly did the rents go up compared to expenses? Okay, so I went pretty conservative. I said $64,000 on that. And here's the last piece. So how we figure out a return, this is the kind of a simple return. We looked at two already. What two kinds of returns did we look at, that Dave looked at? What do we call them?
IRR.
Yep, internal rate of return and cash on cash. Good. So let's look at cash on cash. Here I got that on the bottom. It's cash flow before tax. How do we figure that out? What two numbers did we need to figure out cash on cash return?
The value and the rental income.
Okay, so our total that we put in our checkbook, which was how much? About 10,000?
10,000.
Good. Divided by what we invested. Anybody remember what we invested? 640,000, right. Not 3.2 million, right? That's not what we put in. We only put in our down payment. So it's cash on cash is checkbook money divided by what we put in. So 1.6% cash on cash return. The way it's set up like now. Here's our cap rate, right? Our net operating income divided by our purchase cost, 6.39. All the stuff that we've been looking at today has been below that. And then these top two, they're just different ways to look at it. So this is the one I'm kind of interested in. You take cash flow, principal reduction, and the taxes saved. That I'm looking at about 15%. If I include all four benefits, cash flow, principal reduction, appreciation, and depreciation, if I'm a realtor, that's what the benefit to me is on an annual basis. That's a pretty cool number if they don't change the law. All right, so let's look at some other ratios. Something that I like to look at to kind of evaluate if this property is worth it, just to look for trouble spots, is the operating expense ratio. That's a very simple thing. You're looking at total expenses divided by total income. How much of the property's income is being chewed up to operate it? We don't care about the mortgage, right? Because that's, you might have a cash buyer, it might be a mortgage buyer, but how much of the income is being chewed up? In this case, it's just over 50%. As a rule of thumb, I don't like to see anything over 50% because there's not enough money left to mortgage, to pay the mortgage plus give you a little bit of profit. So rule of thumb, 35 to 50% is kind of where you want to be for expense ratio. Debt service coverage ratio. This is something that banks are kind of interested in, where you say the net operating income, so of course this is income minus expenses, compared to what your annual debt service is. So can you service the debt? In this case, anything that's 1 and above means yes, you actually have more income than your debt service. Once we get to 0.99, that means that the debt is chewing up more than we're producing, and we're going to be taking money out of our grocery budget to fund the property. Of course, this NOI number is all dependent on that vacancy rate, on the rent rate, right, on what we're paying for expenses. So if we end up with 15% vacancy, we're going to be in a world of hurt in this case. Also, break-even ratio is another interesting one, where we take the total expense in debt and divide it by the potential rent. So what this is looking at is saying, how full does the property have to be for me to break even? And in this case, it needs to be 90% occupied. If I've got 90% occupancy and 90% of the people are current and paying rent, it doesn't work to have 100% occupancy and 15% are delinquent, right? Lights are on, no money coming in. That's the same deal. But as long as I'm 90% occupied, this thing will work. Now we put it at 88% vacancy, so that's 92% occupancy, and that's why we're actually making a little bit of money the way this is set up. So when we're analyzing this, what I'm looking at for my client or for myself is I'm saying, where are the opportunities in this? So rather than just flush it because the numbers are kind of like, not too good, it's like, well, what if I made them better? What if, because of what I know, I could make this a profitable investment? What if we reduce that vacancy from 16% to 8%? Well, that's $35,000 a year to our bottom line. There's those garage rents I talked about, 28 units times 40 a month. We could add another $10,000 just in garage rents. What if we could reduce utilities? What if there's some water fixtures we could put in, right? Take those high flow toilets, put in low flow toilets. Is there enough insulation in the attic? All that type of thing. This rubs, this is kind of interesting. It takes a little bit more work to do this, but what you can do, instead of the landlord paying all the utilities, you can actually set it up so that the tenants pay the utilities, even though it's one single bill. Now, you have to decrease the rent a little bit to compensate, but oftentimes, as a gross number, the landlord is able to make a bit more money doing that, rather than paying all the utilities and the tenants are just leaving the doors and windows open. I'm sorry? Somebody say something? Oh, I heard something. A little more work, but sometimes that can be an option, especially for properties with high utility bills. Longer term loan, right? What if we increase the loan to a 30-year? Now that increases our cash flow by $39,000. So we went from $10,000 to $50,000 in cash flow. That would certainly help. So let's look at some cap rates of how this works. So the actual cap rate in 2016 was 5.8 with that NOI. So that was their actual, right? So I don't know who said it, it's not worth it, but if we want a 6.5 cap, that means we could pay 2.8. If we want a 7% cap rate, 2.6, 8% cap rate, we could pay 2.3 million. So depending on where the market is trading, right? If the Sioux Falls market is trading at 8% for this type of property, then based upon that NOI, that's the value of the property, not 3.2 million. And so if you're representing a client, wouldn't this be nice? Instead of listing the stupid thing for 3.2 that you're never going to get, and you're going to beat your head against the wall trying to advertise and do open houses and everything else, wouldn't it be nice to be able to say, hey guys, I know you want 3.2. The reality is right now, that's the value. You want more money? Great. Get the rents up, and then we'll talk. You want more money? Get the expenses down, then we'll talk, right? And so you can be a real advocate for your client in selling and in buying by helping them understand these things. Okay, so let's look at some possibilities. What if we had some better management and reduce that vacancy and increase the garages? So now, this was our actual 2016 NOI. Our new NOI becomes $231,000. Now look at what a 7.5 cap gets us, $3 million. Properties in this time frame, we're trading at about 7.5 cap. Okay, now we're in an offer range where 3.2 is the list price. What if I offered you $3 million? Would you take it? All right, now we're talking. But we know that if we can do these things, then it's worth it. Then there's a deal that's happening. And I think this is why I didn't sell in 2016. If you look online, it's still, the performance is still there, but if you look, their vacancy, they look at their rent roll, their vacancy, they got 2 units vacant. So they've increased it from 15% vacancy almost to 100% occupancy. That looks way better. And so now, yes, now you can command that 3.2 million. Or whatever the offer was. I don't know what the offer was. All right, I know I threw a ton at you, and we're even ahead of time a little bit. So you can toss out questions, but one of the things I want to leave you with is this costs a little bit of money. It's like $40, but Property Evaluator is only for Mac. It can be an iPad or a Mac computer. It does a really good job with calculating these things. So if you don't want to do it by hand, which I know is tedious, this will get you there. And it will give you the IRR, it'll give you the cash on cash, it'll give you the NOI, the cap rate, all that kind of stuff. And it'll look at it over a holding period of 10, 20, 30 years, whatever you want to do. So that's what I've got for you. Questions?
Some of the assumptions you make on those, Josh, I mean, your experience of doing it, you can say it should be more like this.
Right.
But I mean, for realtors in particular, if you're going out there and this is just the first time, you need to get somebody a little bit more professional involved to help you go over those numbers.
That certainly helps, and that's something that we offer you as realtors. We don't charge you for it. So we're happy to look at stuff like this and say, you know, it takes us a little bit of time, but if we can help you sell it, obviously we'd love to be in the conversation for the management, but we'll take that risk that we don't get it. But at least you guys have good numbers to go with. Yeah. And nobody has a crystal ball, right? No, we can never say with 100% certainty. It's just like, well, this is what we see right now, and 2 months it could be a touch different. Yeah.
So, question, Josh, when you're factoring in vacancy as part of this calculation, do you use the Sioux Falls rate of vacancy, or do you use the Real Property Management Express rate of vacancy? And what's the difference?
Neither. Yeah, that's a good question. Okay, good question. So a couple different things. Vacancy in Sioux Falls, right? We've talked about what those numbers are. Again, that's all historic data, so it's always in the past. So what's going to happen in the future? We don't know, right? All it's going to do is trend. So that's one thing. Also, asset class is going to be different. So between single family, duplex, fourplex, apartments, those vacancy rates, even the types, an A class versus a C class will be different. What Merlin's referring to is, what we notice is that vacancy on a turn, so many times days just slip by. Every day that goes by is is money out the door. And so often people don't realize it. We say that vacancy is the #1 expense a rental property has. If you do the math, it's more expensive than a new roof. It's more expensive on average than a new furnace. It's really expensive. And yet people just will do vacancy all day long. They don't care about it. They're like, hey, what does it matter? So what was our vacancy? We track it on a monthly or on a weekly basis. For the last 3 months, we've been running at as low as 3.7, Andrew, and 4.6 is the kind of the high. Yeah, so we're tracking that every single day. Every single day of vacancy matters. Vacancy is an emergency. Because think about it. The difference between 4% vacancy and 8% vacancy, that's 4% return on the entire year, right? So it's a big deal. Vacancy is a big deal. Yeah.
How can you improve vacancy? I mean, what are your tools that you use to do that?
That's the secret sauce.
Yeah.
I know, but I'm saying, just give us a clue. I mean, because you mentioned that in your presentation, how to improve that.
Yep.
Matt comes to mind as, I know it's a connection thing, but it's also probably investing more, right, in advertising and.
So,
are you lowering your rents? I mean, how do you
yeah,
achieve
the #1 thing is time is money. And so we'll see people, especially people that want to do it themselves, they will say, hey, I can save money on not having someone lease it, but then they'll do after hours work, right? So they're coming in after hours, doing work, and it adds how many more days to the vacancy number versus hire it done. Even if you're doing it yourself, hire it done, get it done, right? 1, 2, 3 days, get it done out the door, get it on the market. That's going to save you money. The other thing is obviously marketing like crazy. You want everybody in the world to know it. So websites, Facebook, Craigslist. The other thing we do is we've got a program that allows us for people to advertise or actually look at it online. They can schedule it. So 48% of our showings are scheduled after business hours. So we're not even there. People are scheduling showings, and we've also got it set up that they can look at the property without anybody being there. So if it's vacant, obviously we can't do that when it's occupied. Right now you can go to our website, find a vacant property, type in your information, we verify you with a driver's license or credit card, and then you actually get a code and enter the property on your own. Put the key back and off you go. You can pull up to the property, look at the sign, enter the code, you get in. It just, weekends, holidays, evenings, it just fast tracks how many people we can get to the property, get them in looking, get the application done, and out the door. So if we can cut that down by 15 days, right, that goes from an 8% vacancy down to a 4% vacancy. Every day matters. So right now, actually it's sitting in our office. As rentals, this hasn't really been done on the single family side. We're adding Matterport, so that you guys are familiar with that, right? The 3D digital that you kind of walk through the property. The person can actually walk through themselves through the property. That'll be coming. We do videos right now. We actually do video tours of the property to give out-of-town people an idea, but I think Matterport's gonna be the next thing. So I know apartments would do it, but single family certain aren't. And so we're adding that to the single family space as well. So all these just little things, just every time add, take another day off, take another day off, take another day off, and it adds to your return. Yeah.
Of the single family, what classes do we have most as far as those properties? Is there a sweet spot in there, or high demand, or lack of inventory in certain classes?
It's a good question too. So the question is there a sweet spot for asset classes in single family? So here's the challenge. When you get into the high-end homes, there's a market for it. So I'm talking, you know, 750,000, 500,000 above. There's a market for it. The challenge becomes these ratios don't work for diddly because you can't get enough rent to get the returns that you want. So the sweet spot to get the returns is really 2.25 and under. And even that might be a little high, but that 125 to 225, that's where you're going to see the best rents versus what you had to spend to get into it, because of what people are able to pay, willing to pay, the amount of tenants. Once you get under that, 100,000, now you're starting to deal with lower economic class. You're going to have more damage, more delinquency, that kind of thing. So even though those properties look good on paper, I can make a property look just phenomenal, but that C-class property is going to cause you more cost because of, well, Derek knows we have one, and I was saying the last tenant that moved out was a $10,000 worth of damage, right? So that kind of ate up all that nice income for us, and that was because it was a lower end property, and you're like, now we do well on it. It's still worth it to us, but you have more expenses on that side. So that's what I'd say. 1.25 to 2.25 is probably your sweet spot at this point.
And you said the vacancy rate's about 10% on apartments now?
Yeah, a little under.
Didn't they used to be almost historically like be under 5%? Right? You keep seeing all these big apartments.
Yeah. Oh.
How many units? Are you talking about a duplex or triplex that's 10% or fourplex? Or are you talking about larger units, duplex or smallplex?
Yep, so that's a good question. The question is what type of units are experiencing those high vacancy rates? So understand who those numbers are coming from and how they're being achieved. So they're coming from the South Dakota Multi-Housing Association, and they are interviewing, so it's self-reported numbers, they're interviewing the professional managers in town. So it's going to be Lloyd, Bender, Costello, right, are going to be the main ones. We're reporting our stuff to them. So it's mostly going to be the multifamily stuff that's reporting. You really don't know what the single family is. I think it's lower. I know it's lower than that, right? But what is it? When you have high vacancy for multifamily, like I said, it's going to put some pressure on the single family. It has to, because you're competing with some of the same people, some of the same tenants.
So what are your vacancy rates?
What did we say? 3.7 last week.
For a single family? Or
That's across our entire portfolio. Yeah, so we don't really split it up. Anything that's ready to go, we put it in that number and we say, okay, it's got to be down there. Yeah. But I don't think there's an official number for what a single family would be, quite frankly. Good question. got a question for you guys. With a tool, obviously, or even with that piece of paper, the sheet I gave you, do you think there's a limit to what you could analyze with this? What's the limit? Could you do Trump Tower? You absolutely could. You absolutely could. Yeah, it's the same math, same thing. Numbers are bigger, same math. Depreciation is slightly different, but overall, everything's identical. Yep. Cool. Anything else?
You kind of email the spreadsheet as well, this is part of the CMPS Institute, right?
Yeah, so Dave was going to pull all that together and email it to you. Yep. As long as you signed up on the iPad.
Yeah,
Yeah.
it's on, all.
Yeah, did everybody sign up on that, Beth?
Yeah, go ahead.
So you could analyze Trump Tower, but when it came down to it and you said, oh, this is a bad deal, you would need that experiential knowledge that you guys have to really analyze, okay, but
Yeah.
how could we make changes and make it good?
Yeah, so just to be clear, I have no experience with Trump Tower. So I would be the same boat, man. So, but yes, you could do the numbers, but then it would still be, is this good, is this bad?
Make it better or how?
Exactly. What's the long-term play? How are we getting out of it? Who's going to buy it in the end? Yeah.
Okay.
Yeah.
And then please remember to fill out the survey before you leave, and you can just drop it off in the back. Check a few boxes there.
All right. Thanks a lot, guys. I'll be around if you want to ask other questions.